Welcome to Research Recap on JP Morgan's Making Sense podcast channel. I'm Phoebe White, head of U.S. inflation market strategy at JP Morgan. And today I'm joined by Mike Feroli, our chief U.S. economist, and we're here to discuss takeaways from the September U.S. employment report, as well as the path ahead for the economy and the Fed. Mike, thanks so much for joining.
Thanks for having me.
So there was a lot of good news this morning. Can you just walk us through your takeaways?
Yeah, so most of the major metrics we saw today beat expectations and beat them quite handily. Job growth up 254,000, which is more than double the three-month average going into August. You had unemployment rate move down from 4.2% to 4.1%, almost rounded down to 4.0%. Average hourly earning growth was a tick stronger than expectations. Only soft part was the work week, which moved down. But overall, a report that generally came in, as I said, quite a bit better than expectations.
So let's talk about just that headline jobs number. And I think what's also interesting is in the last few months, we've been seeing prior months getting revised down.
Yeah.
This month, it came with an upward revision to prior months. And again, we're looking at a 3-month run rate now, close to 185,000. So how are you thinking about just the trend in labor demand right now?
So definitely looks better now. You obviously don't want any report to completely change your worldview. If anything, this probably aligns the jobs data a little better with the aggregate expenditure data where, up until today, GDP growth had been looking quite a bit stronger than the labor market data. So now they're both kind of coming back better into alignment right now.
So let's dig into that a little bit and just the spending side of things. Again, payroll growth not softening as quickly as we thought, perhaps, but also average hourly earnings coming in a bit hotter. The year-ago rate back up to 4%. So does that help to explain just kind of the strength in consumer spending, and how are you thinking about the health of the consumer in light of that labor income?
So overall, it looks solid. In the third quarter, nominal labor income grew at a 4.4% pace, which is actually the lowest of the expansion, but still, by the standards of the prior expansion, is a solid number, particularly in an environment in which, well, until this week, energy prices and overall headline inflation have been looking a little lower. So the consumer, we think, still looks fine, particularly after those upward revisions we saw to the saving rate. There's no reason to think that the consumer is particularly fragile right now. So we would expect consumer spending to continue to, hum along here pretty nicely.
So just putting things together, and again, we can't know for sure with one report, but do you feel like the signal now is maybe that growth is stabilizing, or do you think there's still enough data that's pointing to slowing here into the fourth quarter?
We think we're still probably slowing into the fourth quarter and into early next year, though that slowdown obviously looks a little less worrisome than it did before today's report. So I wouldn't, be quite as concerned that we could have a hard landing here. But overall, we think the trend is still modest slowing.
Okay. And then from the perspective of just kind of labor market slack and what that could mean for price pressures, we talked about average hourly earnings, but the U rate moving back down to 4.05%, as you mentioned. Can you just talk about the components of the household survey that contributed to that move? How should we be thinking about the participation rate and the flows and things like that?
Well, basically everything looked better on the household survey. So you had declines in the number of unemployed who were job losers, job leavers, new entrants, re-entrants. It was really quite across the board. The participation rate was stable, and the overall employment to population ratio ticked up 2 ticks. So generally, it's a healthier picture than what we had seen, last month. And again, we're still, you're still up 0.7 from the low on the U rate. So you do still see, broadly speaking, better balance than you did a year ago. But I think the concern that we may be slipping in the manner of like the SOM rule or something like that seems a little less compelling after this morning.
So let's talk about what this means for the Fed. Clearly, we still have an inflation report before the next meeting. We have another employment report. How much does that inflation report matter? And just how will the Fed be thinking about risks heading into that next meeting?
So right now, it seems, like the incumbent move would be 25 basis points, particularly, not only today's number coming in stronger, taking out the need or the case for 50s, but also, we heard from Chair Powell earlier this week that sounds like they would prefer to stay on that path that was laid out in the dot plot, which, presumably has 25s. CPI report will matter. The next jobs report should also matter. It's kind of tricky because it's going to come in the blackout period. So it'd have to be, I think, a real big surprise one way or the other to kind of move us off the path of what seems to be a pretty clear-cut case for 25 as of today.
And in terms of describing the risks, I mean, there's been sort of a shift in tone the last couple of months in terms of saying that there was less upside risk to inflation, there was more concern on the labor market side. Does this kind of shift the way they're talking about kind of the risk balance?
I would think before today, the risks were less inflation and kind of growing concerns about employment. Clearly, this should ease some of those concerns about employment, again, which I think probably helps the case for the 25s as a more gradual move back toward normalization.
Right. And it begs the question of what the path of the Fed beyond even November will look like. And, we've had a pretty swift repricing in markets here the last few weeks. 2-year yields are up, nearly 40 basis points from just about a week and a half ago. Markets are still priced for a terminal Fed funds rate pretty close to 3%. Again, it's moved up around 3.13%. We were well below 3 previously. But just how are you thinking about the path of the Fed into 2025?
Yeah, so we anticipate 25s until you get back to something close to neutral, which our view is similar to the Fed's view there, around 3%. I think after December, the picture obviously becomes a lot murkier because policy uncertainty, sitting here today is pretty elevated, right? So we don't know a lot of the issues that we're going to be facing after the election, nor does the Fed. So I think it's easier to say, how the remainder of the year shakes out. And then I think as we get into next year, we have a forecast, but there's a lot of uncertainty around that forecast.
Right. And I think we'll have a lot to talk about next month. We'll save the election discussion for next podcast. But I think we'll leave it there today. Mike, thanks again for joining.
Thank you.
And thanks to our listeners for tuning in. We hope you'll join us again next month. For more research insights, visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. This communication is provided for information purposes only. Please visit www.jpmm.com/research/disclosures for important disclosures. Copyright 2024 JP Morgan Chase & Company. All rights reserved.